you pondering whether to tap into your home's equity for a financial boost during retirement? Or maybe you're torn between equity release and downsizing. By the end of this video, you'll have all the information you need to be able to make the right choice for you. Equity release, simply put, allows senior homeowners to borrow against the value of their homes. You can choose to get a lump sum payment or a drawdown facility without worrying about monthly repayments. Instead, the money's paid back when you sell your home, which usually happens when you either pass away or move into long-term care. It sounds good, right? But remember, it could become quite costly in the long term and affect your inheritance. So it's important to consider a lender that's authorised and regulated by the Financial Conduct Authority. You're probably wondering, am I eligible? Equity release is mostly for homeowners, usually between 55 and 65 years old. Your property must be your primary residence and above a set value of around £75,000. Now, how does this work? Well, there are two main methods: a home reversion scheme and a lifetime mortgage. A home reversion scheme is simpler, but you give up a larger share of your home sale proceeds. A lifetime mortgage lets you take out less than 60% of your home equity and charges a rolling interest rate which can double the debt in about 10 to 15 years. Here's where the Equity Release Council comes in. They create rules that its members must follow. Member lenders guarantee that homeowners will never be forced to sell their homes under normal circumstances, cover any debt exceeding the home sale proceeds, and allow you to transfer your mortgage if you move homes. So, if you're considering equity release, it's better to choose a provider who's a member of the ERC. Like any financial decision, equity release has its pros and cons. You can spend money that you receive on anything. You don't have to make monthly repayments, and the money is tax-free. However, equity release can become incredibly expensive in the long run. And if you're planning to leave an inheritance, this could eat into it. The decision on equity release is neither universally good or bad. It's highly dependent on your personal circumstances. Some financial experts, like Martin Lewis, even suggest that it can be a good idea depending on your lifestyle and also your circumstances. That's why getting independent personal financial advice is key. If you're apprehensive about equity release, don't worry, you have alternatives. These include downsizing, alternative lifetime mortgages like RIO mortgage and enhanced lifetime mortgage, renting out a room, saving, and you could even start a side hustle. When it comes to choosing between equity release and downsizing, it boils down to your personal preferences, emotional attachment to your home, and your appetite for the property market. Downsizing can be a more advantageous choice, but moving away from a beloved family home can be really challenging. Did you know, even if you've already taken out an equity release plan, you can still move or downsize? It could get complex though, and it would need to be agreed upon with your lender. As I mentioned earlier, equity release can be a great way to free up some cash for your retirement. So let's go into that in more detail. So with downsizing, it's perhaps the most straightforward alternative to equity release. You simply just sell your current home and move into a smaller, less expensive one. This way, you get some immediate cash for your retirement and also pass on 100% of your new property to your loved ones when the time comes. But let's be real, the idea of leaving your family home might not appeal to you. Next up, I was saying earlier about alternative lifetime mortgages. The first is the retirement interest-only mortgage, or RIO mortgage. If the cost of a lifetime mortgage worries you, the RIO mortgage could be for you. Unlike a typical lifetime mortgage, the RIO allows you to make interest repayments, keeping your debt level the same from the time that you took out the loan to when your home is sold. And then we have enhanced lifetime mortgage. This option is great for those who unfortunately don't have much time left due to a terminal illness and want to access more funds than usual. You can reveal your health situation during the application process and potentially get a a larger lump sum to take care of your needs. Now, suppose you love your home too much to leave, but you still need the cash. In that case, you could consider renting out a room in your home. While this could provide a steady income stream, remember any rental income that you receive is subject to tax, so make sure that you report this on your annual tax return. Another alternative is good old-fashioned saving. Yes, it might not be as exciting or as quick, but putting money away each month can build up a healthy nest egg for your retirement. Look for high-interest savings account to help your money grow faster. Also consider a side hustle. Now, many UK retirees have found success with various projects providing them with an extra source of income. It could just be something simple like renting your drive out on Just Park. Remember, while a lifetime mortgage is a popular form of equity release, it's still a loan secured against your property. This means that there are typically no monthly repayments to make, and the loan plus interest is repaid when you or the last remaining applicant either passes away or moves into long-term residential care. Always consider the implications of securing a loan against your home. Now, if you're wondering, should you go with equity release or downsize? It's a tricky question. Financially downsizing could be more advantageous than equity release, as you could potentially get fair prices for both the home you sell and the home you buy. But with equity release, repaying the loan can be less appealing. If finance is all that matters to you, downsizing could be the better option. However, there are factors to consider. For instance, how emotionally attached are you to your home? And can you handle the stress of selling and buying a new home? And how important is your inheritance to your beneficiaries? Let me stress this point. If you've already taken out an equity release plan, you can still move home or downsize, but it will need to be agreed upon with your lender. If the new property is a suitable alternative, then the Equity Release Council states that it should be allowed. If you haven't done it and you're interested in seeing if you could release equity, simply click the link below and fill out the short form. It contains a few questions like your property value and date of birth, and it'll give you access to quotes tailored to your circumstance. It's totally free to fill out and, of course, won't affect your credit score. Click the link below and fill out the short form to try it out.